Okay, well, thanks so much for having us here and letting us both kind of talk about our different approaches to shared equity. I'm going to talk a little bit about the Grounded Solutions Network, kind of how we work, but spend most of my time talking about the Homes for the Future initiative, which is really kind of focused on a specific lane where we see a lot of opportunity, and I think is really relevant for folks who are thinking kind of structurally and systemically about housing affordability and the availability of that over the long term. Um, so to start with, Grounded Solutions, we're a network of about 250, 280 now organizations, and that really runs the gamut from folks who are community-based organizations and community land trusts, local governments who are working on putting together the programmatic and funding infrastructure to scale those programs. We work with foundations, we work with lenders and CDFIs that are trying to build products that make sense for this market. We work a lot with the GSEs and making sure that there's good mortgage availability for community land trust and shared equity homes. And then we also raise capital and do work directly. So we have a broad subset of members. We support them with technical assistance, with strategy development. Some of that's contractually based, some of that's in direct partnership where we're co-investing. And so we really roll a lot of that knowledge and experience into some of the strategic work we do to think about how we might roll out something new that's additive and helpful for growing the field overall. Um, I'll say that we do take as a member organization, we are not necessarily frontline with community groups. We have that membership infrastructure that typically does that, and so we're working in partnership with them to scale the work that they're doing and think about that portfolio growth. And so our goal is really to think nationally about the portfolio of shared equity homes and homes with lasting affordability and think about growing that over the long term. Um, One thing I will say about the shared equity model, just to add to Margie's comments, and thanks so much for kind of setting that up, and it saves me some time, is that we really believe in housing with lasting affordability and housing that with wealth creation potential. And by our math, we really see a lot more wealth creation potential in shared equity than in fee simple, and it's somewhat ironic to say that. But it depends on who you are, right? If you're thinking about the wealth creation for that first homeowner, there's a difference. But thinking systemically, thinking long term, thinking about how you create community wealth over decades or if not generations, you really see a lot more wealth creation when that capital isn't mobile when the first owner sells. And so that's one of the reasons why we really like thinking in partnership with place-based organizations and public governments who really have that long view in mind. So when we think about Homes for the Future, we were asked by our members who are in 46 different states to come up with a way that they could grow those portfolios without being so reliant on the cash NOFAs and the cash subsidy from their local governments every year. They were saying that those NOFAs sometimes are increasing modestly, sometimes are shrinking, but in no place were they saying that they're keeping pace with the increase in housing costs. And so what they said is, as our national network, can you create a different model for us? Help us find a way to expand through a different channel. No surprise to you all. You see a lot of the markets there in Southern California are some of the most expensive in the country, which makes it really, really difficult to do a lot of the work that we do in those places. So you'll see a lot of examples, and a lot of the things that I show on my map are not in that footprint. But toward the end, I've got some ideas of how we can start to change that, as I think is all of our mutual goal. It's really important too that when we think about trying to do something different and trying to expand the way we grow this portfolio, that we're doing it in the context that we've been in the last several years. One of the biggest pieces when we think about single family and home ownership is the institutional single family rental investors that have really been kind of the disruptive force in that segment of the housing market in a way that we hadn't seen before. The mom and pop single family operation that existed really before the Great Recession is not the landscape that we're in now, and it certainly isn't the most efficient way to think about single family rental operation. And so a lot of our work has been focused on understanding that industry, understanding the leverage points of how we utilize the infrastructure that's been built for private investment and use that on the mission driven side to equal advantage. time and place really matter, and that timing moves. So we've seen markets where we really see an opportunity, but the capital isn't quick enough on the mission side, and that what seems good in 2022, you've missed the moment by 2024. And so there's really this question of how you sort of get to the right place at the right time, but move with enough urgency that you can actually take advantage of what you've spotted in terms of opportunities. Um, and lastly, that in the last several years, there's been a lot of growth and change in the impact capital space. Right, we've seen ESG funds kind of grow and then take a step back. But there's still a lot of folks that are really asking this question of what's between a grant and a loan, what's between demanding market rate returns and never seeing that dollar again. And so we're exploring that in partnership with a lot of different investors and foundations. So really, the headline here, what is Homes for the Future? What am I going to talk to you all about? Is an investment strategy that's really focused on acquiring single family homes and using the power of the market over time to replace the cash subsidy or stretch the cash subsidy that would otherwise be required of local government. We really look at renting in places where the economy is strong, where income growth is strong, holding those as rentals for up to 10 years, and then selling those into shared equity so that we're accumulating equity, we're repaying our investors, but we're retaining the bulk of that equity in communities to keep those homes affordable for the long term. The model generally of how we do that, I'll go over a couple of slides. From the timeline perspective, it starts with really partnering with those single family rental operators that have scaled their business, that have the national purchasing contracts, that have sometimes thousands of units in a city, and so they've got their own internal fleet of vans and service providers. And leveraging their ability to acquire, to rehab, and to operate those homes in a way that's really cost effective and is currently benefiting their investors and could benefit impact investors as well. So we raise a fund through a subsidiary of Grounded Solutions, the Homes to the Future Fund. We invest in partnership through those organizations in the same way that their other investors do, and ask them to acquire, rehab, and operate on our behalf, so that those homes stay in mission control. We operate those for, like I said, for a period of up to 10 years. And during that time, we're supporting the tenants, but those folks are tenants. It's not a rent to own. It's not an expectation that tenant will be there for 10 years and buy on the back end. There's a rental period for that home and an ownership period for that home. So again, we're thinking about the infrastructure of available homes, not necessarily just that one family and how they move from renting to owning. So toward the end of that time, we get to the place where I'll get into the financials a little bit, but we've amortized enough capital that we can sell those homes affordably. And at that point, we are working with local partner organizations who are present at the outset, who really advise on location and what kind of product and what the needs are that they're looking for to expand their portfolio. But on the back end, we're selling to those folks at a discount so that they can hit an affordable price point and retain that subsidy over the long term. And that's how we're targeting home ownership when we move out of the rental phase. That's in that 60 to 80% AMI range. This is kind of as deep as we'll go to the financials, and we try to make it pretty clear and graphic. But ultimately, this is sort of the premise of the model, right? Is that in that gold line you have the market rate cost of housing. This is the standard graphic, not in Southern California. I'm aware of that. So you have a market rate cost of housing in the gold line that in strong markets is going to continue to increase. Affordability in a lot of places is below that, right? And so we're really focused in places where that affordability gap is typically in the $50,000 to $75,000 range. And so folks are priced out of the current market. So what we're able to do in those looking at those beige bars, or at least beige on my screen, is we're raising capital to acquire that home at the market price. We're renting that and amortizing and paying down the loan just like you do with a single family mortgage or anything else, amortizing that over time. But we're careful to buy in places where there's also strong income, so that purchasing power increases over time. And so by the time you get into those out years, years 9 and 10, you're at the place where you can sell affordably, which is kind of below that blue line, repay your capital with a return, and still offer someone a home that's affordable with a significant discount to market that makes sense for shared equity. Um, I won't spend a ton of time on the shared equity piece, but really the premise here is that it really is this balance where we can keep something affordable over the long term and allow someone to create household wealth over time. And then it's really a matter of kind of splitting those things rather than having kind of all of one or all of the other. It really is kind of a third path between owning and renting in a lot of ways. The challenge is that it almost always requires this initial public subsidy, which limits how many homes you can do in a market because it's really limited by what the public budgets can provide. In the places where there are active portfolios and active members, we see huge demand for shared equity. So it's not a question of whether or not people want it or whether or not folks who are currently renters would like the opportunity to be in a single family home where they also create equity. It's really limited by what we can find in the subsidy to grow those portfolios. So the alternative here is the fund investment that comes in, acquires those homes, controls that supply, and ultimately exits and sells at a discount to replace that public subsidy. Now, I mentioned in that bar chart that those numbers that I show are not representative of Southern California housing costs, right? And so this works in a lot of places that are in the Southeast and the Midwest and have a much lower sort of cost of home ownership. But also importantly, it's the cost of that acquisition relative to the cost of renting. And so when you look at those, sort of what the costs are, what the rents are, and where you can buy and rent something, the map is really stark, particularly when we start talking about the higher cost coastal places. But the question that leaves us with is not where does Homes for the Future work, but how do we make it work more places, right? And so there's the standard model that assumes no public subsidy, no public partnership. It really is about sort of finding the right market, raising charitable impact capital, and making those acquisitions. So what we've been looking at more recently is how we partner to kind of to stretch that map to cover more places that have the affordability needs, but don't quite have the market dynamics that I described going in the previous slides. So, and we're finding a lot of options and opportunities there. There's certainly sort of the project-based vouchers in that rental phase and ways that the housing authority partnerships and things like that can help sort of solve on the rent side of the equation. We're also looking at certainly states that have property tax exemptions either for nonprofit owners or for community land trusts, which some states have that as a specific option. Of late we've been looking at a lot of portfolio sales from mission owners. So some of those are housing authorities that are needing to sell off their single family portfolios to fund other projects. Some of those are CDCs that have just outgrown being focused on much smaller units that are moving into larger scale projects. So we've been looking at some of those to be able to buy those on favorable terms and still get them the capital that they need. We've been looking at some public land partnerships, and those would be for new construction. But it's a way to lower the cost basis overall in a way that we just couldn't get to in acquiring on the open market. One of the things we've spent a lot of time with, particularly folks in the Texas markets that are really using their municipal issuance authority really creatively, is ways to lower the cost of capital that's really through that municipal issuance and doesn't ask for a cash or asset contribution from that public partner. So it really is a way to grow the pie by accessing the public markets for better capital cost. And then intentionally last on this list is this sort of either a cash subsidy or a soft debt that we tend to shy away from because we really don't want to be in direct competition with all the other affordable housing needs that are often competing for those resources at the local level. But it is a way to make some of this work. So the last thing I'll say is just kind of about where we are with this strategy. We've made our first investment in the Twin Cities. We're working on a second in Atlanta, and we're really sort of in this sort of kind of learn and iterate phase. And as I mentioned, sort of figure out what kinds of transactions and what kinds of structures really open on and unlock the national map a little bit better, and allow us to support and undergird those local organizations that are ultimately going to own this housing for the long term. But we do see a lot of opportunity to sort of prove that out, build on those efficiencies, and start to scale this over time. Like I said, we're really thinking about the national volume of homes that are affordable as rental and as shared equity home ownership. And so we see ultimately our goal and the goal of the partnerships that we pursue is really with folks that are thinking about that overall portfolio scale, and looking to scale sort of what's available to the folks in their communities. So I'll just leave it there, and see what questions might come up.